Welcome to Money Hangout once again. Every week we talk about an important issue, a subject which is of interest to you, answer as many questions that you may have, and help you understand mutual funds better. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about picking the right fund manager. A fund is just as good as the person who is managing it. The fund manager is all important. And it's far more important in a certain kind of fund. The fund manager may be relatively, there are all kind of things provided by the asset management company. When you entrust your money, basically it's a contract between your fund and the asset management company, which basically takes the charge of that money to be managed diligently, complying with the laws, following the regulations, in line with the stated objective in the offer document. So for that they do all the basics, but then beyond that it is the person who matters in certain kind of funds. So fund companies process, their reputation, all those things are definitely material, but beyond that certain kind of fund where the role of that person, his beliefs, his conviction, his experience, his learning from his experience, it matters much more. And so in certain kind of fund, the fund managers matters more. I would like to cite you some examples. Say for example the bond fund, the dynamic bond fund, where there are just too many components to it. The fund manager has to decide on too many variables what to emphasize right now and how to emphasize it. And so he's just not responsible for picking the best, he has a very broad mandate that he can choose a very long maturity bond, a very long duration bond, a lower quality bond. So he's in the business of optimizing, getting you the best risk return trade-off from a selection of bond of any kind. It's a very broad mandate. Likewise, the multi-cap fund, where the fund manager can invest in any stock in the universe, in the investable universe. So here also his selectivity or his brilliance in selectivity can be demonstrated, or his lack of brilliance will also be visible. Likewise, there are other narrower categories where I think the expertise or the belief or the experiences become far more material, and that actually shows in the performance of those categories. If you look at the mid cap and the small cap fund, the manager, when he decides to assume risk and when he becomes risk averse, that is a very big contributor to the performance that you see. When you see the small cap category, you see the best performing fund over the last 5 years and the last 7 years, 10 years, 3 years, longer time period, a full market cycle, definitely which captures a full market cycle. You see that there are funds which have given decent return. You might come across a fund which has given an annualized return of 15-18%, which might look very good. But the best performing ones, or the top quartile ones, or the fund managers where he's able to demonstrate with a large differential, the best performing fund and the large, the not so and the average, the difference could be twice as much. So here the manager matters so much more, and his selectivity, his risk aversion, and his ability to assume risk at different points of time, which I think will is also a function of the instinct. Some people have it better, and some people are able to sharpen it over a period of time, and that shows. So those are cases where you should really you should be worried when a fund manager leaves. But over and above this, I would say that one thing to keep in mind is investment leadership is important. When you see a fund manager moving, don't move your money in a huff, because you should not be taking such a decision in a reflex, an impulsive decision with your money, because there is much more to a fund manager. I'll be worried about a fund if the leadership as well as the fund manager moves. Definitely I'll be very watchful, I'll be very worried, I'll be concerned. And if my money was entrusted to a dynamic bond fund or a mid cap fund or a multi cap fund, a movement of a fund manager who has been around for 5-7 years and more, I will definitely worry. I will give it some time, and see how things change, how things change in the fund, as well as the new fund manager, what he has to say about the kind of changes he's going to make, and allow it some time, maybe 6 months to 1 year, to see that what I expected this fund to do is doing it, and I don't see a very dramatic change or a difference, and then it will be proven over a period of time. But such funds, movement of a fund manager, reason to worry. The best thing, and how you should evaluate a fund manager, I think, a fund manager's continuity is becoming important. Of course, fund managers' mobility, fund managers leaving, they can leave for a variety of reasons. They can just leave for superior career avenue that they might come across. Sometimes a fund manager leaves because he has failed to perform. That's all right. I don't think too many investors will be worried about that. There could be an upside to that. But understanding that, a fund manager who has provided leadership, or managed the money for a long period of time, for a full market cycle, one has to see that has the fund company been able to provide some kind of backup, some kind of team approach that was embedded in it. Many a times bigger funds, as they get older, bigger, more credible, with a larger investors following, they often have co-fund manager. So that, I think, is a good shock absorber. That, I think, is a good risk mitigation. At least there will be a person who has understood why something has found its place in the portfolio and when it has to go. That might be a very useful guidance for you to provide continuity, or there won't be a new fund manager coming and completely repositioning and rejigging the portfolio. May not be a desirable thing, and sometimes it can be profitable, but that kind of continuity will only be helpful. Understanding that the new fund manager comes and continues the same approach to investing is critical. So getting a comfort in terms of where he comes from, how he thinks, will be useful. And value research always keeps you updated with a new fund manager, substituting an old fund manager, and how his thinking is, particularly for the important ones where more investors and have entrusted a large amount of money there. What to do when your fund manager leaves? Keep a watch, and keep a very close watch. It is definitely a red flag, and if a fund manager leaves after being there for a very long period, I think you have to be more watchful, and give it some time. Don't get out in a huff, and give it 6 months to 12 months, 6 months to 1 year, to understand that all the changes that have been brought about, what he thinks about it. And I think immediately on his change for an important larger fund, the fund company will enable or provide you some kind of guidance in terms of who the new fund manager is, where he comes from, how he has worked, how he thinks. And I think those are important things, looking at those aspects, the softer aspects. And many a times these things actually matter less when the stated objective or the way the fund is going to be managed is very well articulated. But still, fund manager is important, and you have to keep an eye on that. Big shifts in market, big shifts in the portfolio complexion is something to worry about. And if that is happening in case of a fund where it was struggling and a new fund manager has come to fix it, that's a different issue. But if it is a fund where you have invested for a long period of time, you have continued investing, you have built your substantial assets there, and you see a fund manager going, I think it's definitely a time to worry. But ensuring that continuity will be provided and getting comfort in terms of who will be managing your money is all important. So fund managers do change. As most things in life, a fund manager will also change. Don't act in a huff.
Thanks, Dhiren.
Thank you.
In our first question, Abhishek asks if he can consider the performance of a fund manager while choosing another fund managed by the same fund manager.
Yes, absolutely. If the fund manager, but it should be of a similar kind. What is the reason why you are doing it? If you actually like a fund manager who is managing a particular fund, and so you should invest in that fund. If that fund manager is going to manage a new fund without the track record, with a different objective, his performance will be different. And there has been, and if he's going to manage a similar kind of fund, there has to be a credible reason why you want to invest in the other fund, which lacks the track record.
Next up, Anirban asks, how much stock overlap is okay between two funds, both when they are managed by the same person and when they are not?
Ideally, you should not be investing in two funds managed by the same fund manager with a portfolio overlap. And overlap between two funds of two fund houses of similar kind is quite unavoidable. That is fine. If you buy two multi-cap, if you invest in two multi-cap funds, there will be common positions. They will have 5 stocks in both the funds and prominent ones with meaningful weight. So that is something which is unavoidable. But I don't see a reason why one should be investing in two funds managed by the same fund manager, which has a significant overlap.
In our next question, Anup asks what the difference between adding a nominee and a second applicant is.
Second applicant is the co-owner. So if two people, they are joint holder, anybody can sign and execute a transaction. Nominee is the beneficiary of succession. So if something happens to you, your nominee will get all the proceeds.
Next up, Arun asks if there is any portal through which he can invest in mutual fund SIPs directly without using an intermediary.
Most mutual fund companies also enable this. Of course, you need to you need to get your KYC before that. And if you have online bank account, it is possible. Most mutual fund companies provide it directly on their website too. And there is another mechanism, mutual fund utility, a common utility platform which enables transaction in most mutual funds in the country. That also enables that.
Moving on, Ashwini asks how he can pick the right debt funds for retired persons.
Depends. First and foremost, I would like to caution you that debt may not be the only option or may not be the best option even for many retirees, even for people who are in retirement and trying to derive income from their investment. Invest in debt to the extent that you require guaranteed income or dependable income, and rest of the money you should consider. And we have talked about this issue, investing for retirement. Look at our archives, and maybe we will do a hangout session once again for investment in retirement and how to invest for income in retirement. But the key principle to follow is, yes, consider fixed income funds, and the fixed income funds to consider will be a combination of income funds and short-term bond funds, and you can derive periodic income from this. Derive the income in the first 3 years by way of systematic withdrawal plan, so they can optimize your return. They have the potential to provide you superior return than deposit of similar tenure. And while you are doing this, you need to do a careful planning that how much income you require. For that, how much you need to invest in fixed income. Remaining money must be invested in equity in a fairly measured way, in a methodical way. You should do your SIP, you should invest in a conservative fund, maybe a balanced fund, because protecting the value of capital, deriving all the income from your fixed income and consuming it will leave you poor, because with inflation your need for rising income will not be met with when your capital remains constant.
Moving back to the subject for this session,
Yeah.
Prakash asks how he can evaluate the history and current performance of the fund managers of the different funds in his portfolio.
Of course, he can look at the track record of all the fund managers, and the way to do it is, you go to value research, look for if you have set up your portfolio, you can click on the name of the fund and you get a fact sheet on each fund. And in the fact sheet itself, you get the information about the fund manager, his education, his background, what he has done in the past, and all the other funds he is managing besides the funds that you have invested in. So you can get a reasonable understanding of how experienced he is, and looking at the other fund that he is managing, assuming that you invest in a fund which you liked for some reason, and you want to see how this fund manager has done while managing other funds. So all those links are provided on our website in the analysis tab, where the fund manager's description, the other funds that he is managing, so you can get full information on the background of the fund manager.
Moving on, Niranjan asks if the fund manager is the only person who manages all the different funds of any fund house.
Yeah, fund managers, there are different fund managers, and there are different fund managers responsible for each of the funds. There is a possibility that the same fund manager is responsible for more than one. In fact, one fund manager might be responsible for managing 3-4 funds together. But every fund must have a designated fund manager. Many a times, each fund or an important fund, or sometimes a hybrid fund, they have co-manager. For example, a balanced fund or a balanced fund typically has two fund managers, one for responsible for looking at the equity component and the other for the fixed income component. Many larger equity funds also have co-manager, so that one can back up for that and provide continuity in just in case one person leaves or one fund manager is not around.
Dhiren, moving slightly back to the question of how value research can help with fund manager evaluation, Gurjant asks if there is a star rating for fund managers as well.
No, there is no star rating for the fund manager, but we have periodically done this exercise for different third-party publications not very long back. In fact, in December 2016, we did an exercise of rating the fund managers based on their track record across different funds in their life. So a fund manager might be moving across fund companies. Somebody was working at company 1 and then moved to company 2. How he did vis-a-vis compared to other funds and relative to benchmark. So we did this annual exercise. This was an interesting exercise. I don't think this is very valuable, but yes, it definitely throws up names who have been able to provide great continuity and or have been able to deliver consistency over a period of time, even though they may have moved jobs. We intend to provide this information less periodically at Value Research Online sometime, once again, at least annually.
Dhiren, our next investor has some skepticism about how much a fund manager's performance can translate into future good performance. Amol says that just as past performance does not guarantee the future of a fund, surely it does not guarantee the future performance of a fund manager as well. Absolutely. He further asks, what factors matter more than fund managers in fund selection?
Yes, he is absolutely right that past cannot be extended to future. Likewise, past, you can't really, one can't really look at the past performance and think that the fund manager will do well. And I would like to just emphasize this point, that there are a variety of reasons why the past is more likely not to be repeated in future. There are many other changes. In fact, a lot of good performance can be attributed to the market. Beyond that, the fund manager's outperformance, the component that you can derive by investing in an index fund, the return over and above that, is a part of it you can attribute it to the fund manager. I think where the fund manager brings in a huge difference is his belief, conviction, and selectivity. Belief and conviction comes from experience, because if one has been through 3-4 market cycles, the fund manager will not get nervous. He will have a deeper understanding. In fact, all the great fund managers we have at Value Research, we had the privilege of interacting with some of the world's finest fund managers globally, and in fact interviewing them. And what we have been able to derive from those interactions is that a great fund manager may not be the most consistent, but in the worst of times he is able to hold on to his beliefs, and in the best of times he is unable to ride the same, he is able to escape the mania. And these two factors actually bring about a huge difference. So I would guess that looking at fund managers, if you want to get into deeply understanding how he thinks, look at some of the interviews that we do. How he thinks matters most. In fact, all the past performance, you cannot derive it. It is just for reference. How he did in the best of times and how he did in the worst of times and how he reacted, I think, is the takeaway from the past.
Dhiren, and his second question relates to what factors matter more than fund managers in the fund selection process.
Fund manager process is one part, but looking at the fund company, and do they have a methodical process of, because the fund's mandate, I think, it builds some, because there is a possibility of discontinuity. A fund manager might leave, so that is when the fund's mandate, its definition, its listing of things that the fund will never do and the listing of things that the fund will do at all times, that becomes very useful. And the other thing is that this thing also comes very handy, because the finest of fund manager also requires a framework to operate, a discipline. And this is where I think the fund manager many a times after 2-3 years of roaring market might become overconfident. So those thoughtful framework or boundaries of operations, or your operating framework, if they are well defined, that becomes very useful. That actually prevents the finest of fund manager to commit a mistake, because market sometimes becomes very heady, and that is time when some of the finest fund managers also go off track. And so operating framework of a fund is crucial. Take a look at that in conjunction with the fund manager. But I think more importantly, of course we are looking at this soft side of how to worry about a fund manager, what to do when a fund manager leaves. I would say that the biggest insurance that individual investors have is, if they choose a diversity, make sure that you are investing in a fund which will remain diverse to a reasonable extent at all times, and you are accumulating regularly, because you are able to de-risk your investment by making sure that you are not overexposed and you are gradually building it up, averaging your investment and diversifying your investment. These are two things which, if you ensure at all times, even a fund manager, when it turns bad, he will not hurt you as much as compared, in comparison to a situation where you have chosen a narrow fund and you have invested a lot of money at one go, which might turn out to be inopportune time.
Thanks, Dhiren.
Thank you.
Our next questioner raises two additional aspects of fund manager selection. Ritika says that sometimes a fund manager's track record is difficult to find because they're new. So what do we do in such cases? And secondly, if the fund is managed by more than one manager, does its performance reflect equally on both the fund managers?
Yes, I would say that, if I'm just answering the second part first, that managed by two fund manager, whom should you attribute the performance to? I would say that even in cases where the fund manager, there is only one fund manager, my own experience of interacting with fund companies, interviewing these fund managers, how the investment teams operate, I think it is a collaborative exercise. Though there is a designated fund manager, but the interaction among the CIO, the various analysts, all the people who provide inputs to the fund manager is a very crucial element. So fund management is a collaborative exercise, though one person might be responsible for the credits and the discredits, or the errors and achievements and the omissions in a fund, but it's a collaborative exercise. It's hard to figure out, if there are two fund managers. Of course, there are funds, in case of a hybrid fund, where the two fund managers are clearly designated areas of two different kinds, it's clear. But in other cases, it is hard to find who contributed how much. But I think it is always beneficial, assuming that it is not equal, and all collaborative exercise, all intellectual exercise, it is very hard to precisely give a percentage, give a score, that who matters how much. But I think collaborative exercises, the biggest thing is that you have your partner, your partner in the whole effort is a bouncing board. Two thoughtful people can hold each other from committing a mistake, can persuade each other from doing so. It matters. They can contribute to the damage, and they can contribute to the bright performance. So look at it. And if I have to having more than two will be a problem, because I don't think fund management can be done by a committee. If there is going to be a fund which is managed by a committee, I would rather go with an index fund. But having two fund manager will provide continuity. And two thoughtful fund manager who stick around for a long period of time, it will act as a good de-risking exercise, and hard to guess how much was contributed by whom.
And Dhiren, the first question is about what an investor should do when the fund manager's track record is difficult to find because they're new.
I missed out on that, which is no, you can't do much, and it amounts to betting. Allow him to deliver, or take your chances with a small sum of money, but it doesn't matter. I think when it comes to choosing funds, I would not like to, I would definitely allow it to build some track record. This is the reason why we do not rate funds till they have a 3-year history, but at least if you don't want to wait till 3 years, look at how the fund is going to be managed. If there is something really special about it, if there is something very distinct about it, and if the fund manager lacks history, and if it is a new fund, you have no way to figure out how will you do.
Next up, Manish asks if it is okay to hold all his funds with a single fund house.
No. The reason why you invest in a mutual fund is to diversify. So the reason why you should diversify, of course, it depends. It's a matter of convenience and scale. If you are investing 2,500 rupees a month SIP, then it's fine. Choosing one balanced fund or a tax saving fund and doing your SIP is okay. But till once you have accumulated your money, make sure that it is diversified across types. The very reason is fund managers' performance can also be cyclical. There are fund managers who do very well in a rising market, and there are great fund managers who struggle in a very rising in a heady market, in a rapidly growing market. So and also, if all your money is invested in same fund house, there is a possibility, because the investment teams work collaboratively. So the views, the views held by the fund or the fund's investment team will be reflected in various funds, even though they may differ a little bit based on the stated objective or the specific objective of the fund. But the overriding factor will prevail, will be reflected, or will be visible in all the funds. So I would suggest that once you have accumulated meaningful scale, depending on your goals or your scale of savings, make sure that your money should be managed by 2-3 skilled people of different places than just one place, because there could be significant overlap, and reflection of same thinking across all your money will make it little more vulnerable.
We now move to our final question for this session.
Sure.
Pramod asks if it would be correct for him to invest in Gilt and Dynamic Funds if the RBI cuts rates in its next meeting, but the US Fed does not.
I don't know about the US Fed, but yes, the behavior of investors matters, because if US Fed gets onto a very accelerated rate hike, then it's a different thing. RBI, at the same time, I would say that many fund managers anticipated RBI's move, and they have been wrong in the past. And I would like fixed income fund investors to err on the side of caution. Just try and match your investments. You can benefit if RBI cuts rates. Definitely bond funds will benefit, but many a times investors have anticipated that it did not happen, and it did hurt them. If you are anticipating that, and that is what most fund managers to also expect, and it doesn't materialize, you will lose meaningful money in a fixed income fund, which is undesirable, and it will also scare you. Always err on the side of caution when investing in fixed income fund, because the returns that you derive from these funds is not much, but the damage it does often takes you back by sometimes few months, sometimes by a year or so. So just match your investment time frame, or be conservative. Don't try to anticipate these moves. Many a times people have been wrong and extremely disappointed, and not so very distant future. It has all been in the recent past.
Thanks, Dhiren.
Thank you.
Any final comments?
Yes, fund manager matters, and once your sizable money invested in few funds, keep an eye on that, but don't act in a huff.
Thank you, Dhiren.
Thank you.
Thank you all for joining us.